Welcome to the Deep Dive. Today we're getting into a new bit of UK policy that's, well, it's already making waves in the country's priciest postcodes.
The high-value council tax surcharge.
Exactly. Though I think everyone's just calling it the mansion tax, really. Okay, let's unpack this.
Let's do it.
Our mission today is pretty simple. We want to give you the fast track to understanding the kind of financial tremor this is expected to cause.
Especially in London.
Especially in London, yes. And what it means for the whole UK housing market. The most, striking thing we pulled from the sources was this projection.
That 5% figure.
That 5% figure. That high-value properties in London, so anything over £2 million, could see a one-off drop of about 5% next year. I mean, that's a really sharp adjustment.
It is, and it's because the market is pricing in the lifetime cost of this new tax right now, immediately. So to get into the mechanics of it, the surcharge is aimed at properties valued at more than £2 million.
Okay.
The cost, it's an annual thing, starts at about £2,500, and that goes up to £7,500 for homes over the $5 million arc.
Right, but here's the bit that I think is crucial for you to get your head around. We're seeing forecasts for next year, but the tax itself doesn't actually kick in until April 2028.
That's the key.
So why are buyers reacting today? Why this 4-year gap?
It's because the market is always forward-looking. The second a future cost is confirmed, buyers start to adjust their offers downwards.
To account for it.
Exactly. If you know you're going to be on the hook for, say, an extra $5,000 a year from 2028, you deduct the value of all those future payments from what you're willing to pay now.
And that calculation is essentially the 5% drop we're talking about.
That's it in a nutshell, yes.
I understand the mechanism, but isn't there a danger here? Could this just push wealth out of London entirely? I mean, forecasts are suggesting London might be the only UK region to see prices fall next year.
It's a real possibility, and what's so fascinating is this concentration effect. The vast majority of these high-value properties are in London, so the impact is just magnified there.
And you have other things at play too, right?
Oh, absolutely. There are compounding factors. Stamp duty is already much higher in the capital, which penalizes transactions. And with all the political uncertainty, those high-end assets are just, more sensitive to any new tax.
So it's a perfect storm for London's luxury market.
In a way. But the picture completely changes as soon as you look outside of London. Step outside that M25 boundary, and it's a different world.
Right. So let's connect that to the bigger picture.
The wider UK market looks stable, maybe even resilient. Nationally, we're looking at growth of around 2.5% in 2026. Then it cools a little to 1.5% by 2028.
And some regions will do even better.
That's the projection. Places like the Midlands, Northern England, they're expected to outperform the capital. They benefit from being more affordable. And, of course, the expected easing of interest rates will help them more. So really like two separate housing markets reacting to the same policy.
So it's a localized adjustment in the luxury segment, not a national housing crisis.
Precisely.
And we're already seeing behavioral shifts. People who are thinking of selling are now, just holding off?
They're delaying, yes, waiting for the dust to settle, hoping to absorb less of that 5% hit. At the same time, some new buyers are being put off by those extra holding costs.
So for owners of these assets, this becomes a strategic question, doesn't it?
It absolutely does. Careful planning is now critical. They need to think about the best time to sell, look at their financial exposure, and maybe even restructure their portfolio.
Which is a polite way of saying move their money out of London property and into something else.
It could mean that, yes, into other assets that are less exposed to these kinds of taxes.
Yeah.
But it is important to stress, the sources are clear, that this 5% drop is seen as a short-term correction.
Not a long-term decline.
Exactly. The market adjusts, it finds its new level, and then it stabilizes.
So what does this all mean? When it comes down to it, this mansion tax is causing some short-term chaos and a lot of planning headaches, but it's really focused on London's high-end market.
It's forcing a price correction in the capital.
Right. While the rest of the UK housing market just carries on with its slow and steady growth.
That seems to be the outlook.
Now, the sources did mention something that I thought was really interesting, that this tax might actually encourage some homeowners to downsize, to release these big multi-million-pound properties onto the market.
Freeing up housing stock.
Potentially. And that leaves us with a really interesting final thought for you to consider. What happens to the character, to the whole social dynamic of these very affluent neighborhoods if you get a sudden rush of large family homes for sale? Does that change the kind of buyer who can move in? Something for you to chew on as this all unfolds.